A basic building block of economics and management information for the farm is cost of production. Knowing your unit cost of production will guide you in answering the three fundamental business management questions: what to produce, how to produce it, and how much to produce. Production cost and returns analysis begins with good farm records. It combines financial records on one hand with production records on the other. Farm managers can then see the relationship between the use of a particular production input and its subsequent cost and return per unit produced. Unit cost and returns are calculated on a crop and an enterprise basis. An enterprise is an activity that uses farm resources to produce a commodity or a group of commodities with common production traits. Unit costs and returns measure economic efficiency. They are a statement of the value produced and the costs required per unit produced. With this information in hand, the manager can employ the basic economic rule: keep adding inputs until the cost of the last unit applied is equal to the value of the last product produced. As long as the cost of the additional input is less than the value of the added commodity produced, adding inputs adds to profit. A historical tally of unit costs and returns reveal how effectively farm inputs and resources were converted to farm products. This historical conversion, with adjustments for changing prices of products and inputs, gives insight into potential production costs and returns in the future to help assess which crops to grow. Production costs and returns reports are organized into four separate categories: value of production, or gross returns; variable or operating costs such as feed, seed, fertilizer, herbicides, fuel, repair, and hired labor; fixed costs or overheads, including interest on debt, insurance, property taxes, and depreciation; and finally, margin, the amount left over to cover remaining costs and provide a return on the operator's equity. Value of production reveals how well the business creates both quantity and quality of product. More efficient production means we're getting better yields for inputs applied. Price of the product relates to its qualities. Both of these elements are affected by the inputs used and the farm management choices made. Production costs, as the term implies, are driven by the quantity and price of inputs used and the resulting level of production. Production analysis helps to identify operational efficiencies, particularly when production costs rise, and it's a great starting point for identifying and assessing farm strengths and weaknesses, areas for short-term improvement, and areas for long-term improvement. Addressing these requires an evaluation of unit production returns, costs, and margins. In a production cost and returns analysis, each margin has a specific link to an economic decision rule or management function. Contribution margin, or return over variable costs, is the first and simplest margin. It is commonly used in shorter-term applications such as cattle feeding or crop planning, and can be interpreted as what's left over to cover overheads and other obligations. When developing a crop plan, your starting point should be based on the crop with the best contribution margin. Gross margin, or return over cash costs, relates to the ability of the activity or enterprise to generate cash flow. This can help management identify cash flow stresses and the related risks. Gross margin is commonly viewed as what's left over for operator withdrawals to account for debt principal and to set aside for future risk management and capital purchases. Profit, or return to equity, is what's left over after all production costs are accounted for. It represents the return to the operators for their equity and management invested. Profit also forms the pool of retained earnings, from which the business reinvests in itself and covers its risk. Over the long term, production of a commodity must turn a profit. The sum of profits and losses across all activities and enterprises reveals a statement of profit for the farm as a whole. A production costs and returns analysis by commodity and enterprise is useful in that it highlights which commodity and which enterprise has contributed to farm profitability. Looking into the future, historical analysis gives insight to some of the risks a business faces. Provincial ministries of agriculture collect and publish production cost and returns benchmarks for numerous farm enterprises. These can be a valuable source of comparison to individual producers. However, the most important piece of management information is the one that applies to your farm from your own records and experience. Managers who invest time in production cost and returns analyses can more effectively evaluate past strengths and weaknesses and project profitable operating plans for the future. For more information, hop onto the Alberta Agriculture website and review our Business and Economics tab.